bank customers discovering hundreds, even thousands of dollars taken out of their accounts without permission.
And the bank blames the problem on a computer glitch.
Bank of America customers say money is missing from their accounts.
Imagine waking up to find that your bank account balance has plummeted to zero. This nightmare became a reality for many as $100 million in deposits mysteriously vanished overnight. How did this happen, and what does it mean for the banking system and your financial security? In a shocking turn of events, $100 million in deposits disappeared from bank accounts, causing widespread panic among customers. This incident has raised serious questions about the security of our banking systems and the measures in place to protect consumers. This video explores the events leading up to this crisis, its immediate impacts, and the broader implications for the banking industry and customer trust. Drawing on recent studies and reports from 2024, we aim to provide a comprehensive understanding of this unprecedented financial disaster. The incident and immediate response. The sudden disappearance of $100 million from bank accounts shocked customers and financial experts alike. According to a 2024 report by the Financial Times, the incident was first noticed when numerous customers began reporting discrepancies in their account balances. Panic quickly spread as more people checked their accounts and found their funds missing. How did this happen? Initial investigations suggest that the incident was caused by a sophisticated cyber attack. A 2024 study by the Cybersecurity and Infrastructure Security Agency, CISA, identified the use of advanced malware that infiltrated the bank's systems. This malware was capable of altering transaction records and siphoning off funds without immediate detection. The hackers targeted the bank's core processing systems, enabling them to manipulate data on a large scale. The affected bank, identified in the CISA report as one of the top 10 largest in the country, immediately launched an internal investigation and contacted federal authorities. The bank assured customers that their funds were insured and that efforts were underway to restore account balances. The incident led to widespread panic among customers. Social media was flooded with posts from individuals expressing their frustration and fear. Many reported difficulties in reaching customer service, and some even lined up outside bank branches, seeking answers and assurances. A 2024 survey by the Pew Research Center found that over 60% of affected customers lost confidence in the bank's ability to protect their assets. The broader implications for the banking industry. The disappearance of $100 million in deposits has far-reaching implications for the banking industry. This event has highlighted vulnerabilities in the banking system and raised questions about the adequacy of current cybersecurity measures. A 2024 report by the Bank for International Settlements (BIA) has emphasized the growing threat of cyber attacks on financial institutions. The report noted that banks are increasingly becoming targets for cyber criminals due to the vast amounts of money they handle and the critical role they play in the economy. The BIS report called for enhanced cybersecurity protocols and greater investment in technology to safeguard against such attacks. The incident also brought regulatory and compliance issues to the forefront. Financial regulators have stringent requirements for banks to protect customer data and funds. However, this incident exposed gaps in compliance and oversight. The 2024 study by the Federal Reserve highlighted the need for more rigorous enforcement of cybersecurity standards and regular audits to ensure compliance. Customer trust is the cornerstone of the banking industry. The loss of $100 million in deposits severely undermined this trust. According to a 2024 Gallup poll, trust in banks dropped by 20% following the incident. This decline in trust could have long-term implications for the banking sector, as customers may become more reluctant to keep their money in banks or use digital banking services. The incident also has broader economic implications. The sudden disappearance of such a large sum of money can disrupt economic stability. The 2024 International Monetary Fund (IMF) report warned that large-scale cyber attacks on banks could lead to financial instability, affecting not just individual banks but the entire financial system. The IMF recommended that countries strengthen their financial infrastructure to mitigate the risks of cyber threats. Bank accountability and customer protection. Banks have a crucial responsibility to ensure the security of their customers' deposits. In the wake of this incident, how banks handle customer protection and compensation is under intense scrutiny. The affected bank took several steps to address the crisis and reassure customers. These measures included: 1. Account restoration. The bank worked to restore account balances as quickly as possible. Affected customers were informed that their deposits were insured up to the maximum limit set by the Federal Deposit Insurance Corporation, FDIC, which is $250,000 per depositor per insured bank. 2. Temporary credit. To mitigate immediate financial hardship, the bank issued temporary credits to affected accounts. These credits allowed customers to access funds while the investigation and restoration processes were underway. 3. Customer support. The bank increased its customer support resources, including setting up a dedicated hotline and additional staff to handle the surge in inquiries. Special support centers were established in affected areas to provide in-person assistance. Long-term accountability measures. Beyond immediate responses, the banking industry is now focused on long-term measures to prevent similar incidents and enhance customer protection. 1. Enhanced insurance coverage. The 2024 Federal Reserve study suggested that banks could offer additional insurance coverage for deposits beyond the FDIC limit. This would provide greater peace of mind to customers with significant balances. 2. Regulatory reforms. The incident has prompted regulatory bodies to consider stricter guidelines for cybersecurity. Proposed reforms include mandatory real-time fraud detection systems, regular stress tests for cyber resilience, and higher penalties for non-compliance with security standards. 3. Compensation policies. Banks are also reviewing their compensation policies to ensure timely and adequate restitution in case of future incidents. The creation of a standardized compensation framework, as recommended by the Bank for International Settlements, BIS, could streamline the process and ensure fairness. 4. Public transparency. To rebuild trust, banks are being encouraged to adopt greater transparency in their operations. This includes regular public disclosures of cybersecurity measures, incident response plans, and updates on any security breaches. Case study: Bank of America's response to a major cyber attack. A 2024 case study by Harvard Business School analyzed Bank of America's response to a similar cyber attack that occurred in early 2024. The bank successfully mitigated the impact through a combination of proactive measures, including immediate public communication. Bank of America was quick to inform the public about the breach, detailing the steps being taken to resolve the issue. This transparency helped maintain customer trust. Advanced cybersecurity measures. The bank had invested heavily in advanced cybersecurity technologies, which limited the scope of the attack and facilitated quicker recovery. Customer compensation. Bank of America promptly compensated affected customers, ensuring that all lost funds were restored within a week. International media. International media have extensively covered the labor market disaster, emphasizing its global implications. Reports from major outlets like the New York Times, BBC, and Reuters have highlighted the economic and social challenges faced by China. The global media narrative has focused on the need for structural reforms and international cooperation to address the crisis. Several scenarios could unfold as China navigates the labor market disaster. Scenario 1. Economic recovery. In the best-case scenario, the government's stimulus measures and policy interventions could lead to an economic recovery. Successful implementation of infrastructure projects and technological innovation could create new jobs and boost economic growth. This scenario would require effective coordination between government, businesses, and educational institutions to address the skill mismatch and ensure workforce transition. Scenario 2. Prolonged economic instability. In a less favorable scenario, structural challenges and policy inefficiencies could lead to prolonged economic instability. The job losses and economic slowdown could persist, leading to social unrest and political challenges. This scenario would require sustained efforts to reform the labor market and address the underlying issues. Scenario 3. Global economic impact. The labor market disaster in China could have lasting effects on the global economy. Disruptions in supply chains and trade tensions could lead to a slowdown in global growth. This scenario would require international cooperation and policy coordination to mitigate the impact and ensure global economic stability. The disappearance of $100 million in deposits has exposed significant vulnerabilities in the banking system and underscored the importance of robust cybersecurity measures. This incident serves as a wake-up call for banks, regulators, and customers alike. By learning from this experience and implementing stronger security protocols, the banking industry can better protect customer assets and restore trust. If you found this analysis of the banking crisis insightful, don't forget to subscribe to our channel and hit the notification bell to stay updated on future videos. Share your thoughts in the comments below. What do you think about the security of your bank accounts? How do you believe banks can improve their cybersecurity measures?